Hi, my name is Trevor Austin. I'm the founder of Authentic Life Financial Planning, and today we're going to be talking about tariffs, uncertainty, and volatility. Before we get into the content today, I do want to just make it clear that the markets are scary, and it's okay to be scared right now. There's a lot of uncertainty. There's a lot of concern around what the tariffs mean for our economy and prices and what's going to happen in the future. The reality is no one knows what the future holds. I don't have a crystal ball as much as I would love one, and no one else has one either. No one knows what's going to happen with the tariffs. No one knows what's going to happen in the short term here. And because of that, that's part of the reason why the markets are reacting the way that they are. They just don't know where things are going to go. And so it's okay to be scared. It's okay to be frustrated by what's happening right now. And it's okay to feel like you need to do something for your finances to make sure you're going to be okay. What we're going to be talking about today are what things you can do today, especially if you have equity awards, to take advantage of what's happening in the markets. The agenda for this video is we're going to talk a little bit about the tariffs and the uncertainty and volatility that's come from them. And then we're going to talk about tax loss harvesting. We're going to talk about tax gain harvesting. And we're going to talk about stock options. One thing that I do want to be very clear about is all three of the actions I'm suggesting you consider today really only is helpful if you have public company stock. If you have private stock instead, the reality is that price isn't going to fluctuate as much. That doesn't mean that there's nothing you can do today to take advantage of that, but it does mean that you may not be able to take advantage of the buy down that's been happening the same way that someone at a public company is able to do. So one thing that I just want to be clear on, I've gotten this question recently, is the only reason the market is dropping due to the tariffs? And the reality is yes, 100%. The only reason that markets are fluctuating like they are right now, while we're seeing all that volatility happening over time, and it's really not been up, it's mostly been down so far, is due to the tariffs. Markets do not like uncertainty. They like when things are kind of go with the flow. We as human beings like when things are certain and known and going with the flow. A significant policy change like what was announced last week is a big change, right? And markets aren't really sure what is going to happen. They're not sure how Europe and China and the rest of the world ultimately is going to respond. And so there's a lot of unknowns with what's going on right now. And markets don't like that. Markets like certainty, they like steadiness. They don't like big policy change announcements that they did not already see coming. And so that leads to the volatility that we've seen over the last week. This screenshot was from end of day on Tuesday. The S&P 500 over the previous 5 days had lost 11%. Most of that really just coming from April 3rd and on. And as I said, the markets don't like uncertainty. They don't like big policy changes that they did not expect in advance. And so when that happens, they kind of freak out. They get scared. Because ultimately, all the big institutional investors are humans as well, right? There's someone behind the curtain managing everything, right? And they get scared as well. They get uncertain. Again, they do not like uncertainty, just like we as individuals don't like uncertainty. That's just human nature. So when we have a big policy change like we're experiencing right now, the reality is no one really knows what's going to happen in the future. That being said, we've seen things like this play out before. We've seen markets tumble. We've seen COVID happened. We saw a pandemic. We've lived through the great financial recession. We've seen big, complex changes like this happening over time. So from that side of things, this isn't new. What is new is what is causing the uncertainty and the economic questions that exist today. It's been a long time that we've had tariffs anywhere near the size that we seem to have at this point. It's a big policy change. It's been a very long time since we've had tariffs anywhere near this. If we look at this chart, it's all the way back in the 60s and early 70s that we've had tariffs anywhere near what has been proposed. And so when a big change like that happens, people don't know what's going to happen. The markets especially are short-term in nature, where we as individual investors have to think long-term. We can't get caught up in the emotion that happens with the volatility that happens when there's a lot of uncertainty. We shouldn't do that. Now, that doesn't mean that we can't be scared, and it doesn't mean that we can't be concerned about what's going on. I think it's healthy, quite frankly, to be concerned about what's going on and a little scared. It's completely normal. It's human, ultimately. Now, just because we're scared and concerned and upset doesn't mean that we have to make big financial decisions today. We don't have to. We can if we want to, and if it makes sense with our long-term vision, we should do that. However, if making those changes is not in alignment with your long-term vision, then you shouldn't take that action. One thing that I'm counseling my clients currently on is moving to cash. I firmly believe that moving to cash is not the right move right now. It has nothing to do with what is causing our current financial uncertainty. It has nothing to do with what's happening in the world overall. It has everything to do with the fact that it's basically impossible to time the market well enough that you are doing better than if you just stayed invested. It's effectively impossible to do that. And the reason why that's the case is because it's very, very, very difficult to time the bottom of the market, or even if you're not timing the bottom, the actual bottom, but just getting close to that, it's so difficult to time that correctly. The reason for that is that when markets do start to rebound, things will still be scary. Things will still be uncertain. If we look back just at the COVID drop in 2020, the bottom was March 23rd, 2020. We still had no idea what was happening with COVID on March 23rd, but that was the bottom. Do you know when most clients were calling and telling me that they wanted to get out in 2020? March 23rd. They were so scared. There was so much uncertainty and so much unknowns and fear around that time that people were scared and were trying to get out at that point. But what they didn't know, and what we didn't know at the time, is that that was the bottom. And if they had just waited a month, they would have been fine and happy that they didn't get out on March 23rd. Similarly, we have no idea when the bottom will hit with the current economic uncertainty that we have. It could be today. It could be 5 weeks from now. It could be a year from now. We just have no idea when that bottom is going to hit. And so the last thing you want to do is move to cash today. I realize that can feel scary to not take action when things are scary. But the reality is that specific action is probably the worst thing that you can do for your future self. So since I'm suggesting you don't do something like that today, like going to cash today, I do want to talk through some things that actually can make sense, especially if you have equity in your employer. There's 3 things that I want to be talking about with what I think you should be considering right now. Actions that you can take that actually will improve your long-term results. The first is tax loss harvesting. Now, tax loss harvesting is really just a tax play Ultimately, what it is selling an investment that is down in value, purchasing a different investment, and taking that tax loss so that you can offset income in the current year or potentially income in future years, including future capital gains. Now, this only applies to taxable accounts. It does not apply to your 401k. It doesn't apply to your IRA or Roth IRA, HSA, any retirement account. Ultimately, it does not apply to you. It only applies to taxable accounts. So as an example, if you have RSUs or non-qualified stock options in a public company, this could make sense. It also could make sense if you have proceeds in a taxable account from a previous equity grant that is now diversified and invested in the broader market, but is down in value. It can make a lot of sense to do this because ultimately it'll allow you to pay less tax in the future or incur gains in the future without having to pay tax. So it can be really valuable. It can save you a lot of money in the future. And right now is a great time to consider this option. There are a couple of things that I want to make very clear, though, with this strategy. I already mentioned that it has to be in a taxable account. It can't be a retirement account. The second thing is the investments do have to be at a loss, which means that the cost basis has to be higher than the fair market value. One thing that I do want to make clear is I want to talk about the wash sale rule. Essentially, the wash sale rule says that you cannot purchase a security that is substantially identical within 30 days before or after the sale, when you sell at a loss. And so, as an example, if you have stock in your employer and you sell it at a loss, you cannot purchase that stock 30 days before or 30 days after the date of sale. So technically speaking, there's 61 days. There's a 61-day window where you cannot purchase that security. Now, you can purchase that security. It just, that number of shares will then be deducted against the loss. I won't go into depth on the watch sale rule today. Just be aware that it exists. There's many different resources out there that talk through that and how it operates and how to avoid that. So I'm not going to cover that here, but just be aware that it exists. And essentially, if you're thinking about doing this with employer stock, you'll have to wait 30 days to repurchase it. And again, technically it's 31 because the 30-day windows does not include the date of sale. So just to recap, you do have to have taxable accounts. You do have to have investments within those taxable accounts that are at an unrealized loss, and you cannot purchase an identical or a substantially identical security within 30 days before or 30 days after, because then it's a wash sale and you can't use that on your tax return then if it's a wash sale. So let's look at an example. So Will Be Rich is an employee of XYZ company. It's a large public tech company, and he receives restricted stock units each year. So far, he's not sold any shares, and he currently owns 1,000 shares of XYZ stock. The current fair market value is $100, just like most companies within the S&P 500. It's been affected by the recent tariff news. The average cost basis that he has for those 1,000 shares is $120 per share. And so he has an unrealized loss currently of $20,000. Will finds himself in the 24% tax bracket. And if he were to sell just 150 shares of his stock, so 15% of what he currently owns, he would have a $3,000 loss, which in his situation, assuming there's no other taxable gains or losses this year, that could be a potential tax savings of $720. Now that's only if he were to sell 150 shares, which is currently about 15 grand in his situation. Another option for Will is he could potentially sell all 1,000 shares, which means that he'd actually have a $20,000 loss and have a much larger tax savings than what I'm showing. Another opportunity for him is if he were to repurchase the stock after 30 days and it's gone even further down, he's able to reset the basis and able to use the loss against any future gains that he has. Now, it is very risky to try to do this selling and repurchasing with company stock if you're going to sell company stock and repurchase the company stock, because individual stock especially is very volatile, right? It's going to fluctuate a lot more than the broader market is. And with what's going on right now, that's just going to be even more magnified. So if you're going to do this, I generally would not try to do it by selling your employer stock and then repurchasing the stock, 30 days later. I wouldn't try to do that. What I would consider doing is selling either stock or some other taxable investment that is at a loss currently, at an unrealized loss currently, and investing in something else. Now, again, if we look back, it does have to be it cannot be a substantially identical security. So you can't sell an S&P 500 index fund and purchase another S&P 500 index fund. You have to buy something else that is substantially different from that fund. Again, I gave the example of restricted stock. I generally wouldn't do this if you're planning to sell and repurchase that same stock, but it can make sense if you are selling stock and want to invest in the S&P 500 as an example, or you want to sell stock and just diversify overall to the broader market. Just if you're trying to diversify, this can make a lot of sense to do that right now. Now, yes, you're at a loss, and that sucks. You don't want to sell at a loss generally, but if you're selling and reinvesting, that can make some sense. The second strategy I want to talk through today is tax gain harvesting. Tax gain harvesting is essentially the opposite of tax loss harvesting. Instead of selling at a loss to save some taxes, you're selling at a gain, paying some tax, and then reinvesting soon after. This strategy, it makes a lot of sense if you do have restricted stock or stock options or any other individual security. It can make a lot of sense to do this. And the reason why is, unlike tax loss harvesting, tax gain harvesting does not run into the wash sale rule, which means you can sell the stock one day and repurchase it the next day. You may even be able to repurchase it the same day. I think theoretically that is fine, but certainly confirm that with a tax advisor before you take that action. But the benefit with tax gain harvesting is that you can repurchase soon after. You don't have to be outside of that 61-day window. Again, from a checklist standpoint, it has to be a taxable account only, has to have an investment that has an unrealized gain. The asset value has generally reduced recently, which again is likely with what's going on right now. It can also make sense if you're in a lower than normal income year. And again, you can repurchase the investment the same day or the next day. You don't have to be outside of that 61-day window like you do with tax loss harvesting. So the question maybe is, why would you do this? Well, there's two reasons. One is if you have a capital gains tax budget, which I think everyone should have that, this allows you to realize some of that gain, adjust the basis to the new current fair market value, and because you're selling and repurchasing, you realize that gain and pay a little bit of tax. But because you're selling in a down period, it allows you to pay maybe a little bit less tax. Again, allows you to reset the cost basis and allows you to pay a little bit less tax than you would otherwise. Unlike tax loss harvesting, I generally would do this if you're planning to sell and repurchase that same security. I don't know if I would necessarily do that if you're planning to sell and invest in something else. Like if you're trying to diversify your company stock position, now may not be the right time. However, that gets into market timing, and I generally don't believe in trying to time the market. I generally believe in diversification, and I generally believe in being allocated appropriately based on your goals and long-term plans. But times like this can be a really good time to realize some gain, pay some tax, but pay less tax than you would be paying if you were selling 3 months ago or even a couple of weeks ago at this point. And so it can make a lot of sense if you're planning to sell the stock and repurchase that same stock. That's where I kind of see this making a lot of sense. So let's look at an example. So again, we have Will Be Rich, same situation, still at the same company, fair market value is the same, number of shares are the same, tax bracket is all the same, everything's the same. The only difference is that the average cost basis is now only $80 per share instead of $100 per share. And so in this situation, what Will has decided to do is that he is going to sell all of his stock today and repurchase. He's going to realize this $20,000 gain. In his situation, that likely means that he is going to be paying a 15% long-term capital gains rate plus net investment income tax, but he'll avoid the 20% long-term capital gains bracket from a federal standpoint. Because it's long-term capital gains, he's not paying the ordinary income tax rate of 24%. He's paying a little bit less than that. And the benefit to this is because he plans to continue to hold this stock, he's able to realize some gain, pay some tax now, but then repurchase and essentially reset the basis to $100 per share. And so what this allows him to do is it allows him to kind of tax plan for the future so that if the stock continues to do well in the future, he's able to realize gains again in the future at a lower difference between the fair market value and the basis. The other option that he may have is if the stock continues to perform poorly, if the market continues to go down, he may actually end up having the opportunity to do some tax loss harvesting. What's kind of cool about this is that if he were to repurchase in, right now at $100 per share, and things continue to look worse, after 30 days, he could sell, realize the loss, and that $20,000 gain may end up being a lot less, depending on what the stock price has done. Just as a quick, brief example, if the stock drops now to $80 per share, and he sells at that point, he now has a $20,000 loss, which means he's offsetting that gain. Essentially, he's resetting his taxes for the year, resetting the basis, resetting the value, and essentially is wiping away that gain. And so this can be really valuable. Again, it really is just a tax play, a way to manage capital gains now and in the future. But given what the market had done previously up until today, and given what it's done the last couple of weeks, it can make a lot of sense to do something like this. My guess is that with a lot of people right now, they are in this bucket. They may have, FANG stock that has done really well the last couple of years, since 2022 or even earlier, and it may not be at a loss yet, right? It may not fit what makes sense from a tax loss harvesting standpoint, but given where it's at, tax gain harvesting can make a lot of sense. And since you don't have to worry about the wash sale rule, you can sell and repurchase the same day. The last strategy that I want to talk about has to do with stock options. It really only applies to public company stock options. It really won't apply to non-public company stock options, private company stock options. There may be room for what I'm talking about, but in general, it's going to be more effective if you have public company stock. And so let's talk about exercise strategies with stock options, because I really do believe that this strategy that I'm proposing really only makes sense if you're going to continue to hold the shares. So the exercise strategy that we're going to focus on is this cash exercise. We're going to ignore the cashless and we're going to ignore the sale to cover. We're just going to focus on the cash exercise. In a cash exercise with stock options, you pay cash to purchase the shares. You don't sell any shares and you receive the stock at purchase. What that means is that you're not selling any stock today, you're just purchasing the stock, which means you have to have cash to cover the exercise cost as well as any taxes that are going to be owed. And so this exercise strategy can make a lot of sense if the stock has not appreciated significantly yet, you believe it will in the future, and you have enough cash to cover the exercise cost, the taxes, as well as just your normal living expenses. You have a full emergency fund, you have any other large things you're trying to do in the next 2 years are covered. If that situation does not exist, then this strategy does not make sense. But if it does, it can allow you to exercise at a lower tax cost and continue to hold the shares going forward. Let's look at an example. So May B. Rich is an employee of XYZ tech company. It's a large public company, and she has some NSOs. She has 5,000 shares. The exercise price is $50 per share, and the fair market value is currently $70 per share. So if she were to fully exercise her options, the cost to, the bargain element, which is what is going to be taxed, would be $100,000. So that number would be included in her W-2 for the year, and that amount is what would be taxed. So she likely would pay, depending on other income she has for the year, likely 25 to 40%, if not more, of that 100,000 would have to be paid as taxes. Obviously, that depends on, again, other income, what state she's in. There's a lot that goes into that, so I don't have an estimate of what that would be. But again, likely it would be 20 to 40% given many different factors. So for May, she would need to have enough cash to cover that tax cost as well as the exercise. That's not a small amount of money. That's 250 grand that she would need to have as cash to pay the exercise cost, and the taxes would be on top of that. So for her, the total cost likely would be close to $300,000. However, she doesn't need to do all 5,000. She could choose to do 1,000 or 2,000 or some amount that actually makes sense for her financial plan and her life. Now, you may be asking, well, why would you choose to do this now? And you have to remember that I'm suggesting that this makes sense if you want to exercise and hold the shares. It probably doesn't make sense to do this right now if you just want to sell the shares. And the reason for that is because things are volatile. Things are, in general, down right now. And so if your plan was to just exercise and sell and get out of that stock, this strategy may not make sense. But if you have enough cash and your long-term projections look good, that you can spend some money on investing in your company stock, this can make a lot of sense. It reduces your tax cost. So as an example, let's say instead of the market dropping due to the tariffs, we're looking at this back in February, January, where the market was still at new highs, and the stock for XYZ Tech Company was at $87.50 per share, which is 20% higher than where it was at in my previous example when it was $70 per share. And so if we look at it from that standpoint, if May wanted to exercise and hold, then her tax cost almost would have doubled just because the difference in price of 20%. So instead of 100,000 showing up on her tax return, it would have been 187,500 showing up on her tax return. Again, almost double just from a 20% price change, which means if May plans to continue holding the stock, she can save a huge amount of money in taxes by exercising now. And again, just because she can exercise all 5,000 shares doesn't mean she should. Maybe it makes sense to do that for her, maybe it doesn't. But knowing that there's a huge amount of tax that could be saved by exercising now when it's at $70 per share instead of $87.50, it can make a lot of sense to exercise now. Again, only if you're going to hold. I know I keep harping on that, but that's the reality. If you're planning to exercise and hold the stock long term, exercising now will save you a huge amount of taxes. Again, none of these options are for everyone. None of these options will make sense for a lot of people. But for people who have equity compensation, now is a really great time to save some taxes by doing one of these three strategies. Between tax loss harvesting, tax gain harvesting, and exercising your public company stock options and holding them, you could end up saving tens of thousands of dollars in taxes. Now, I don't know about you, but saving a huge amount of money on taxes makes me feel pretty good, and would make me feel like I was at least accomplishing something when markets are scary and when things feel uncertain. We as human beings feel like we need to do something when times are scary. Our fight or flight instinct kicks in. Doing something usually means that you're going to be leaving money on the table. But it also can feel like doing nothing is wrong as well. Doing nothing feels like you've given up. Doing nothing makes it feel like we're not in control of our own future. Doing nothing feels scarier than doing something, even if it's the wrong something. And again, doing something feels better than doing nothing. And I think it's important to recognize that and make it clear that it's okay to feel scared right now. There's a lot of uncertainty with what's going on, and there's a lot of fear happening right now. And it's okay to recognize that you're scared. That being said, doing something that will harm your long-term future, is not what you should be doing right now. And so the three things I covered today are all proactive things that you can be doing right now that will make your long-term look better. And ultimately, that is what each financial decision that we make should be doing, is making our lives better. Thanks for watching. If you found this video helpful, please like, subscribe, and drop a comment below with any questions or topics that you would like to see covered. Financial planning is all about creating the life you want. Let's build it together.